2026 is not just another year, it's a turning point, and most people won't realize it until it's too late. The rules that helped people survive the last decade are quietly breaking down, and those who keep following old advice will pay the price. History shows that moments like this don't destroy everyone. They separate winners from losers. This warning isn't about fear, it's about awareness, because the decisions you make before 2026 will quietly determine whether you struggle or grow when the system shifts. For more than a decade, the global system was built on easy money. Interest rates stayed low, liquidity was abundant, and borrowing felt almost painless. This environment encouraged spending, speculation, and risk-taking at every level, from governments to corporations to everyday individuals. When money is cheap, inefficiency hides easily. Bad decisions survive longer. Weak businesses stay alive, and people begin to believe growth is permanent rather than cyclical. Easy money changes behavior before it changes outcomes. People stop asking how things are funded and start focusing only on short-term gains. Asset prices rise not because productivity improves, but because more money chases the same opportunities. This creates an illusion of wealth where rising numbers are mistaken for real value. Over time, this illusion becomes deeply embedded in decision-making, and reversing it becomes psychologically and politically difficult. As conditions tighten, the system begins to reveal its true structure. Higher interest rates don't just slow growth, they expose who was dependent on cheap borrowing to survive. Businesses that relied on constant refinancing struggle. Governments face higher debt servicing costs. Consumers discover that their lifestyles were supported more by credit than income. This is how power quietly shifts, not through dramatic collapse, but through pressure that rewards strength and punishes fragility. The end of easy money doesn't arrive evenly. Some sectors feel it first, others later, but no one is completely insulated. Capital becomes selective. Instead of flowing everywhere, it concentrates in areas with strong balance sheets, predictable cash flows, and long-term relevance. This is when the gap between those who planned conservatively and those who assumed continuation starts to widen. The environment no longer forgives excess. Economic power always moves toward those who control capital during transitions. When money is abundant, access matters less. When money tightens, control matters more. Institutions and individuals with liquidity gain influence, while those dependent on borrowing lose flexibility. This dynamic reshapes markets, labor, and even geopolitics, because financial strength translates directly into decision-making power. Another consequence of tightening conditions is the revaluation of risk. Assets that were priced for perfection begin to adjust to reality. Growth assumptions are questioned, margins are compressed, and leverage becomes a liability instead of a tool. This process feels uncomfortable because it challenges beliefs formed during the easy phase. Many people respond by denying the change rather than adapting to it. Historically, these periods create both stress and opportunity. Those who understand that cycles are normal don't panic when conditions shift. They recognize that tightening is not an accident but a response to excess. Instead of reacting emotionally, they reposition gradually, focusing on durability rather than speed. This approach doesn't produce instant results, but it builds resilience as conditions evolve. The shift in economic power also affects individuals. When credit tightens, job security changes, wage growth becomes uneven, and career paths that once seemed stable face disruption. Skills that depend on expansion lose value, while skills that improve efficiency, reduce costs, or solve essential problems become more important. This is how economic shifts translate into personal outcomes. What makes this phase particularly challenging is that it unfolds quietly. There is rarely a single moment when easy money officially ends. Instead, conditions tighten incrementally, and by the time most people accept the change, the advantages have already moved elsewhere. Those who wait for clarity often find that clarity comes after opportunity has passed. Understanding the end of easy money is not about predicting exact dates or events. It's about recognizing incentives and adjusting behavior accordingly. When borrowing becomes expensive and capital becomes cautious, the rules change whether people acknowledge them or not. Those who align with the new environment early gain flexibility, while those who cling to the old one face forced decisions under pressure. Debt is a powerful tool when used correctly, but it has limits. For decades, the world has relied on borrowing to fuel growth, whether through government spending, corporate expansion, or personal consumption. At first, debt accelerates growth and amplifies opportunity. Economies expand, businesses invest, and individuals enjoy lifestyles that might otherwise be unattainable. However, debt is not neutral. It carries a cost, and when that cost rises faster than income, it creates pressure that can't be ignored. Every economic cycle has a phase where debt accumulates faster than the system can comfortably sustain. At first, it appears manageable because interest rates are low and growth is strong. Borrowers can refinance, governments can roll over obligations, and confidence remains high. This period encourages risk-taking and creates a sense that borrowing is inherently safe. Yet beneath this surface, fragility builds. Each new loan increases obligations, and each expectation of continued low rates becomes a potential source of vulnerability. As debt grows, the system becomes increasingly sensitive to shocks. A small rise in interest rates, a slowdown in growth, or a drop in confidence can create disproportionate effects. Companies that once thrived on cheap credit struggle to cover costs. Governments face budget pressure that forces difficult choices. Individuals find themselves over-leveraged, with income unable to meet obligations. What once seemed stable begins to wobble, and the cracks in the system become more visible. Debt cycles also create inequality in outcomes. Those with resources and liquidity can navigate higher interest costs and economic pressure, while those who relied heavily on borrowing become constrained or forced to liquidate. History shows that periods of debt stress transfer wealth from the overextended to the prepared. The lesson is not theoretical. Decisions made before the breaking point determine whether you benefit or suffer when adjustments occur. Another challenge is psychological. Borrowing creates confidence during expansion, but it can create panic during contraction. When debt levels peak, uncertainty rises and decision-making becomes reactive. Businesses delay investment, consumers cut spending, and markets become volatile. These shifts amplify the impact of debt because the system depends not just on numbers, but on behavior. Fear can be as damaging as financial stress, and those who anticipate the cycle remain calm while others overreact. Debt cycles are reaching a breaking point because borrowing has been pushed to extremes. Public and private debt has grown faster than underlying productivity in many economies. Interest payments consume more of budgets, leaving less room for growth-oriented spending. The system has reached a stage where adjustments are inevitable. Ignoring this reality does not postpone consequences. It accelerates them once a tipping point is reached. The breaking point is not always sudden, but when it arrives, it forces rebalancing. Some debts are restructured, some assets are devalued, and some institutions fail. Those who prepared in advance have options and flexibility. Those who did not are forced into reactive measures under pressure. Timing matters because the system does not wait for latecomers. Understanding debt cycles is about patterns, not predictions. History repeats with variations, periods of easy credit, rapid accumulation, overextension, and eventual adjustment. Those who recognize the stage of the cycle position themselves to protect wealth and seize opportunities. They focus on liquidity, risk management, and resilience rather than chasing unsustainable gains. On a personal level, individuals can reduce vulnerability by avoiding excessive leverage, diversifying obligations, and maintaining cash or liquid assets. On a larger scale, businesses and governments must manage debt with caution, anticipating that conditions can change quickly. The ultimate goal is to survive stress and emerge stronger, rather than being caught unprepared when the cycle turns. Debt cycles are structural forces. They cannot be eliminated, only managed. By understanding where the cycle is heading, decisions can be proactive rather than reactive. Those who take this approach maintain flexibility, preserve capital, and are able to act when opportunities appear. The difference between winners and losers in this environment is not chance. It is preparation, discipline, and timing. Wealth is not static. It flows between those who understand the rules of the system and those who ignore them. In times of economic stability, the differences are less obvious, and many people assume that effort alone guarantees success. But during periods of transition, especially when cycles shift sharply, wealth is redistributed rapidly. Those who anticipated changes, diversified their assets, and understood the underlying risks are positioned to benefit, while those who relied on assumptions or luck are often forced to give up what they have. Preparation is more than saving money or holding investments. It is about understanding vulnerabilities. Many people assume that rising markets or increasing debt levels are permanent, and they make decisions based on the continuation of past trends. This mindset creates exposure. When conditions change, these assumptions break down, and the value people thought was secure begins to erode. Meanwhile, those who analyzed scenarios, prepared for multiple outcomes, and avoided over-leveraging maintained stability and flexibility. One key factor in this redistribution is liquidity. Those who have access to cash or readily convertible assets during periods of stress can act decisively. They can acquire undervalued assets, invest in opportunities that others cannot reach, or simply maintain financial independence without forced selling. In contrast, those without liquidity may be compelled to sell assets at depressed prices, effectively transferring wealth to the prepared. This is a recurring theme in economic history. Timing and readiness dictate who benefits and who loses. The psychology of preparation is equally important. Being prepared requires discipline, patience, and the ability to act rationally under pressure. Emotional reactions often drive poor financial decisions. Fear can cause panic selling, and greed can cause overextension. Individuals who anticipate market swings and act according to a plan rather than reacting emotionally tend to preserve and even grow wealth during periods when others struggle. Wealth transfer also occurs at a structural level. Companies with strong balance sheets, governments with manageable debt, and investors with diversified portfolios are able to navigate turbulence more effectively. Those who ignored fundamentals, relying on high leverage or overconfidence in market trends, often face forced adjustments. This redistribution is not necessarily sudden, but over months and years the difference becomes clear. Success is cumulative. Those who take small, consistent actions to prepare gain an increasing advantage, while those who delay experience compounding disadvantages. Another dimension of preparedness is knowledge. Understanding economic cycles, financial instruments, and historical patterns gives people a framework for decision-making. Without this knowledge, decisions are reactive, often based on headlines or trends rather than fundamentals. Education, analysis, and strategic thinking become as valuable as money itself because they guide how resources are deployed when conditions change. Opportunity is always tied to risk. Those who recognize emerging risks and position themselves appropriately are often the ones who benefit most when conditions shift. For example, during market downturns, undervalued assets can be acquired at favorable prices, while over-leveraged entities struggle. The prepared anticipate this imbalance and act accordingly. Their wealth grows not from speculation alone, but from disciplined positioning that exploits structural weaknesses in the system. Wealth also moves through networks and influence. Those with connections, insights, and access to information can act faster than those without. Preparation includes building relationships, understanding systemic trends, and maintaining the ability to respond. People who neglect these elements often miss opportunities or are forced to follow others' decisions under less favorable circumstances. Importantly, preparation is cumulative and proactive. It is not a reaction to fear or crisis. It is the steady work done ahead of time, anticipating change rather than waiting for it. People who prepare consistently gain resilience, allowing them to maintain stability even as the broader system becomes unpredictable. Their actions compound over time, creating advantages that are difficult for the unprepared to replicate. Ultimately, the redistribution of wealth is a natural feature of economic cycles. It is a reflection of who understands risk, who acts with discipline, and who remains flexible when conditions shift. Those who prepare are positioned to capture opportunities, while those who ignore warning signs gradually lose influence, capital, and control. Recognizing this principle and acting on it is one of the most reliable ways to maintain and grow wealth as cycles evolve. As we approach 2026, the financial landscape is set to change in ways that many people fail to anticipate. Traditional assumptions about cash, assets, and risk no longer hold true, and strategies that worked in previous cycles may fail entirely. For decades, holding cash was seen as safe, certain, and predictable. Stocks were viewed as growth vehicles, bonds as stable income, and real estate as a hedge against inflation. But the coming period will challenge all these assumptions, forcing individuals and institutions to rethink how they manage their resources. Cash, in particular, will behave differently than most expect. Low interest rates in the past created the illusion that holding cash was risk-free, but inflation erodes purchasing power, sometimes faster than anticipated. When economic cycles tighten, cash becomes a double-edged sword. It provides flexibility and liquidity, but it also loses value relative to certain assets if not managed carefully. People who hold large amounts of cash without considering inflation or alternative stores of value may find themselves losing purchasing power even if their account balance appears unchanged. Assets, too, will experience unusual behavior. Markets that previously moved in predictable patterns may become volatile and disconnected from traditional fundamentals. Stocks may react sharply to interest rate changes, corporate earnings, or geopolitical events. Real estate may experience uneven demand depending on local economic conditions and borrowing costs. Commodities may surge or collapse based on supply shocks or currency fluctuations. The era of assuming a linear relationship between risk and return is coming to an end. Flexibility, diversification, and understanding correlations between different types of assets will be more important than ever. Risk itself is being redefined. In the past, risk was often measured by volatility or historical performance, but these metrics may no longer provide accurate guidance. Structural changes in debt levels, inflationary pressures, and geopolitical tensions can create scenarios where high volatility assets outperform low risk instruments, and vice versa. What appeared safe in a previous decade may suddenly carry hidden exposure. Conversely, assets that were considered risky may provide protection if positioned strategically. Understanding risk is no longer about following averages. It is about analyzing the dynamics of the system and preparing for multiple outcomes. Liquidity will also play a central role. In times of stress, the ability to convert assets into cash quickly becomes a decisive advantage. People who overcommit to illiquid investments may struggle to respond when conditions change, while those who maintain optionality can act when opportunities appear. This is a critical distinction because even profitable investments can become burdens if they cannot be accessed or sold at the right time. Managing liquidity alongside diversification will be essential in 2026 and beyond. Behavioral factors will amplify these effects. Investors often react emotionally to market movements, chasing gains and fleeing losses. When cash, assets, and risk behave unpredictably, those reactions can lead to rapid wealth erosion. Conversely, individuals who remain disciplined, adhere to principles of risk management, and anticipate non-linear behavior can take advantage of dislocations in the market. Preparation, patience, and rational thinking will separate those who gain from those who lose. Another factor is the interconnectedness of global markets. Actions in one region can ripple across currencies, interest rates, and asset prices worldwide. Cash held in one currency may lose value relative to others. Assets that are heavily correlated with global trends may experience sudden swings. Understanding these connections and their potential impact on personal or institutional portfolios is no longer optional. It is a requirement for anyone aiming to preserve or grow wealth. Timing will matter more than ever. Entering or exiting positions at the right moment, anticipating shifts in liquidity, and adjusting exposure to risk dynamically will define success. Waiting for certainty may mean missing opportunities, while acting without preparation may result in unnecessary losses. In this environment, strategies must be adaptive, proactive, and grounded in a deep understanding of systemic behavior.